Hey guys, and welcome back to the show where we talk about all things stock related. We look at what's happening in the markets, we look at different trading strategies, and we also look at just how well stocks and investing are in terms of growing and building you up. So today's session, what we're actually going to be talking about is why is investing a much more powerful tool than saving. So to actually answer this question, with investing, it actually leads to a lot of growth. So when you're considering investing, you mainly think about one or two things, either how you can grow the funds or how you can cash flow from the asset that you have. So when you think about growing the funds, you look at the growth rates, you want to look at how the markets are operating, you want to really select the asset class that best serves you for this. So when it comes down to wealth preservation now, there are many different asset classes that can be used to preserve your wealth. There's the stock market, there's the real estate market, there's the commodities market, so that's gold, silver, and there's the crypto market, like Bitcoin and those kind of stuff. So when it comes down to investing, the best thing that you can do with investing that saving in an account would not do is compounding. Now, Albert Einstein actually has a quote where he says that compounding is the eighth wonder of the world. He who knows it benefits tremendously, while he who doesn't pays for it. So what this really means is, if you understand compounding and you know how powerful compounding is, then you actually would be able to benefit greatly from it. But if you don't understand what compounding is and you invest in the markets trying to compound your investments, then naturally you'll pay for it because you'll be consuming losses on top of losses on top of losses. So this really is it. And so when it comes on to investing in the stock market, there's so many different ways to invest in the stock market. Now, you can invest in the stock market to grow your net worth. So if you currently have a certain net worth and you want to increase it, stock market is a great place to grow your net worth. If you want to preserve your wealth, the stock market is also a great place to preserve your wealth. And if you want to get cash flow, then this is also a great place to get cash flow from. And to get cash flow from the stock market, it really is dividend stocks that you'd be getting. So you'd be looking stocks that pays 10% or more in dividends. And usually stocks that pays higher dividends usually has less growth. So what that means is that the price tends to be less volatile, but the dividend payouts are steady. So if your main goal is to cash flow in the stock market, dividend stocks would be. But if you're looking to increase your net worth, then growth stocks are a great place to invest. And this would also be dependent on your strategies and how you are going about investing in the market. And the stocks are not the only way to increase your wealth. There are also many other places that you can go to increase your wealth. So there's a real estate market as well too. And I was actually listening to Robert Kiyosaki and his Rich Dad radio show, where he actually had a very interesting and deep discussion, and where he actually spoke about why he loves real estate, and he was talking about taxes and the breaks that you get from it and all those sorts of stuff. But the thing that stood out to me the most was, he said that if he has $1 million, he can go to the bank and he can borrow 10 million, and then you can purchase properties from that. So if your goal is to cash flow and you want to look into real estate, and let's say you've been working 5 years and you have $10,000 saved up in your bank account, now you can actually go to the bank and you can get a loan for $100,000. So let's keep it simple. So get a mortgage, 100,000, you pay down 10% on the property, which is $10,000. And let's say it's near a college. So as a college, they need housing. So you get it, you renovate it, all of that for the 110,000 that you have, because you borrowed 100,000, you already had 10,000. Now, let's say that the semester starts and you're able to charge $850 per month just for renting out this home, apartment, whatever you want to call it. Let's just call it a one-bedroom apartment. So you charge $850 for this one-bedroom apartment. Now, you got a loan from the bank for 100,000, and they gave you, let's say, 20 years to repay. And long story short, the repayment amount is $500 a month. Now, that's $350 that positive you're making that you would not have had initially. So now that is $350 positive cash flow that you're getting, because you're charging $850 to that renter. You're taking $500 and you're paying off the mortgage. You have $350 left in your pocket. Now, depending on how you'd set up your rental agreement, you might have your light, electricity, water, those sorts of stuff. Or you might charge that separate, or you may just pay for it out of what you collect from them. So that really is it. So that's $350 you would have cash flowed positive each month, and for 10 months you'd have earned $3,500. So in less than 2 years you'd have already earned back that $10,000 that you would have put into that property. And that really is it. And then after that, no, everything else that you earn would be a positive cash flow for you. And that really is how investing differs from saving in the bank account. Now, if you're the type of person you like to diversify, and let's say you've earned that $350 positive cash flow and you want to preserve that wealth. Now, a strategy that you could do is you could then take that positive cash flow and invest it in gold and silver. And that way you'd even be diversifying against all other assets. So you'd be diversifying against inflation and the dollar and the rising costs. You'll be diversifying against the market volatility, and you'll also be preserving your wealth, because right now gold is at about over $2,500 per ounce, and silver is at about $35 an ounce. And so with that, you would be growing your net worth, and you'll be also having a steady cash flow that you can keep and maintain. And if you want, you can even purchase additional properties. And so this really is how investing really works, and how true diversification works. Not diversifying across paper assets, because stocks, bonds, mutual funds, they're all the same asset class. It's just a different type of asset, but it's still paper assets, because stocks are issued based off companies, bonds are debt, so it's either corporates, which should be businesses, or government debt, and mutual funds are just created by actual brokers or investment firms to allow for persons to diversify. Now, there's nothing wrong with investing in these types of assets, but having all your funds in one asset class really isn't a very smart strategy to have, because anything can happen, and if things go negatively, you can possibly lose some or all of your money. And so as we go looking into the savings account now, so if you were to have that same $10,000 that you'd have bought a property with and you've earned a positive $350 cash flow from, and you decided to invest it in a high yielding savings account, and let's say that that savings account is paying you 2% per annum. Now, if you invest that $10,000 in the savings account and earn 2% on it, that's $200 that you're making every year on it. And that $200 is taxed. So you'd actually be you'd have to do 5 years to earn your first $1,000, and that would be 10%. So to earn 10% on that $10,000, you'd have to have it in the savings account at five years. So with that, to actually earn that $10,000 back on 2%, it would have taken you about 50 years to earn back that $10,000. Whereas if you had bought real estate, you'd have made it back in less than 2 years. And so with the bank account, it really is not designed to preserve or increase your wealth. Bank accounts really are just for liquidity purposes, and nothing is wrong with having a bank account because we all need bank accounts to do transactions and do businesses, but the bulk of your money should be outside of the banking system and in the investment system. So we speak a lot about stocks on this show because it really is designed for stocks, but whatever asset class you decide to go into, that is fine. Just ensure that you do your research, you stick with it, you actually get educated, and if you can afford it, seek mentorship or coaching, and then start going into that asset class, whether it's gold and silver you're going to go into, whether it's cryptocurrency, whether it's real estate, whether it's stocks, whatever asset you choose to truly invest in. Ensure that you have that strategy, you have that plan, and then you go about investing in it, because that's the only way that you will be able to not only preserve your wealth, but you'll also be able to grow that wealth as well too, because having your funds in the bank account is just going to be sitting there and you're going to be paying taxes on it. And some accounts, they actually charge you to put your money in it, and that's the craziest thing to me. Like, why would I open an account with you and then I have to pay you to keep my money? Like, what benefit does that have to me? I'm losing money. And I'm also losing money on inflation, because inflation right now is about 2.5% in the US. So why would I put my money in a high yielding savings account earning 2% and I actually have to pay to maintain that account? So that's two losses I'm making. I'm making both losses on fees just to have that money in the account, and they probably call it maintenance or some fancy fee they call it. And I'm also losing money based on the inflation. So the real value of my money is getting less and less each year. And that doesn't make any sense to me. I'm not saying don't have a bank account, because bank accounts are important, they are needed. But if you really want to grow and preserve your wealth, the investment world and different asset classes is your way to go. And stocks is really the easiest and the lowest entry barriers to entry of the asset classes, because if you want to do real estate, you need to have about 10% of the actual value of the property, and you need to show the banks that you won't be a high risk or default on the loan. If you're going to gold, well, your money will really just be sitting there. It's not really, in terms of the value, it grows, but gold is really just hedging against inflation and the costs, the rising costs in the dollar. So when the dollar is getting weaker, more persons tend to invest in gold, which is ties back into the inflation. And so with stocks, the fees are really low. The barriers to entry are low. You can open the account 24 to 48 hours, and these are the reasons why I love stocks. I'm not saying the risk is low, because the risk is based on how you invest. So you can have high risk, you can have medium risk, you can have low risk. So it really is dependent on the investments that you go into. That's all for today, guys. Thank you so much for tuning into this session. I do hope that you liked it. If you did, feel free to give us a thumbs up or a heart and leave any comments down below. I will get back in touch with you guys. And if you feel that you have a friend, relative, family member who would benefit from learning and this information, gaining knowledge from this information, feel free to share it with them and subscribe as well to the channel so that you do not miss out on any new episodes as soon as they are launched. Until next time, take care. Love you guys. Bye.